Hey guys, welcome back to the channel. So today we're going to be talking about mutual funds, right? What are they? A couple different details about them, trying to understand them. A lot of the basics that we can go ahead and get out of the way, right? So first off, what is a mutual fund? A mutual fund is a type of financial vehicle made up of a pool of money collected from a bunch of investors to invest in, different things like stocks, bonds, money market instruments, different, real estate, just a bunch of different assets, right? Mutual funds are operated by, professionals. I'm going to say quote unquote professionals, because you yourself can, you know, I feel like you can make your own portfolio as well as someone else can, and it basically can be your own personal mutual fund. But that's for a later conversation, right? But a professional money manager will, operate this mutual fund, and it allocates the fund assets and attempts to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus, right? So, mutual funds give small or individual investors access to professionally managed portfolios of equities, bonds, or other securities, right? And each investor participates proportionally in the gains or losses of the fund. So mutual funds invest in a vast number of securities, and performance is usually tracked as the change in the total market cap of the fund derived by the aggregating performance of the underlying investment. So let's try to understand mutual funds, right? Let's try to get a grasp on them. So the mutual fund is going to pool money from the investing public and use that money to buy other securities, stocks and bonds are generally the big ones, right? Most of the time it's going to be a lot of stocks, right? Usually you buy a mutual fund that like tracks a sector or like the overall market, right? It's usually one of those. The value of the mutual fund company depends on the performance of the securities it decides to buy. So, when you buy a unit or share of a mutual fund, you're buying the performance of its portfolio or part of the portfolio's value. Investing in a share of a mutual fund is different from investing in a share of stock. Unlike stock, mutual fund shares do not give its holders any voting rights. A share of the mutual fund represents investments in many different stocks or other securities instead of just one holding. That's why the price of a mutual fund share is referred to as the net asset value or the NAV per share, sometimes expressed as NAVPS, right? Net asset value per share. So the fund's net asset value is derived by dividing the total value of the securities in the portfolio by the total amount of shares outstanding. Outstanding shares are those held by all shareholders, institutional investors, and company officers or insiders. Mutual fund shares can typically be purchased or redeemed as needed at the fund's current NAV, which, unlike a stock's price, doesn't fluctuate during market hours, but it is settled at the end of each trading day. So the price of a mutual fund is also updated when the NAVPS is settled. The average mutual fund, it holds, we're talking anywhere from probably 50 to 100, 200 different securities in it, depending on how diversified they want it to be, which means mutual fund shareholders gain a lot of diversification at a lower price. Consider an investor who buys only Google stock before the company has a bad quarter. You're probably going to lose a great deal of value because all those dollars are tied up in that one company, right? All your money's tied up. On the other hand, a different investor may buy shares of a mutual fund that happens to own some of Google stock. When Google has a bad quarter, right, that person's going to lose significantly less because Google's just a small part of that portfolio. So, how do they work, right? Well, a mutual fund is both an investment and an actual company. This dual nature may seem a little weird, but it's no different from how a share of Apple is a representation of Apple, right, itself. when an investor buys Apple stock, he's buying partial ownership of the company and its assets. Similarly, a mutual fund investor is buying partial ownership of the mutual fund company and its assets. The difference is that Apple is in the business of making innovative devices and tablets, while a mutual fund company is in the business of making investments. So, let's talk about the typical ways an investor will earn a return from a mutual fund, right? We're going to talk about 3 different ways, okay? So, number 1, income is earned from dividends on stocks and interest on bonds held in that fund's portfolio. A fund pays out nearly all the income it receives over the year to fund owners in the form of a distribution. Funds often give investors a choice either to receive a check for distributions or reinvest the earnings and get more shares. If the fund sells securities that have increase in price, the fund has a capital gain. Most funds also pass on these gains to investors in a distribution. If fund holdings increase in price but are not sold by the fund manager, the fund shares increase in price. You can then sell your mutual fund shares for a profit in the market. So, if a mutual fund is construed as a virtual company, its CEO is the fund manager, sometimes called its investment advisor. The fund manager is hired by a board of directors and is legally obligated to work in the best interest of mutual fund shareholders. Most fund managers are also owners of the fund. There are very few employees in a mutual fund company. The investment advisor or fund manager may employ some analysts to help pick investments or perform market research. A fund accountant is kept on staff to calculate the fund's NAV, right, which we talked about earlier, right? The daily value of the portfolio that determines if share prices go up or down. Mutual funds need to have a compliance officer or 2 or 3, right? And most likely need an attorney. That way they can keep up with government regulations. Most mutual funds are part of a much larger investment company. The biggest have hundreds of separate mutual funds, right? Like just so many. Some of these fund companies, their names are familiar to, like, you and me, right? So like Fidelity Investments, the Vanguard Group, T. Rowe Price, Oppenheimer, right? So let's talk about the different types of mutual funds, right? Because mutual funds are divided into several kinds of categories, representing the kinds of securities they have targeted for their portfolios and the type of returns they seek. There is a fund for nearly every type of investor or investment approach. Other common types of mutual funds include money market funds, sector funds, alternative funds, smart beta funds, target date funds, and even like funds of funds, right? Or mutual funds that buy shares of other mutual funds, right? So you've got equity funds, fixed income funds, index funds, balanced funds, money market funds, income funds, international or global funds, specialty funds, and then a lot of people's favorite thing ever, which is ETFs, right? Exchange traded funds. So, it's just, there's so many, and it really comes down to picking what you want. I would say most people are going to pick like an index fund or an ETF. Like most people, that's probably the 2 biggest ones that your average person is going to invest in, right? So along with these are mutual fund fees, right? Because a mutual fund will classify expenses into either annual operating fees or shareholder fees. Annual fund operating fees are an annual percentage of the funds under management, usually like 1 to 3%. Annual operating fees are collectively known as the expense ratio. A fund's expense ratio is a summation of the advisory or management fee and its administrative costs. Shareholder fees, which come in the form of sales charges, commissions, redemption fees, they're paid directly by investors when purchasing or selling the funds. Sales charges or commissions are known as the load, of a mutual fund. When a mutual fund has a front-end load, fees are assessed when shares are purchased. For a back-end load, mutual fund fees are assessed when an investor sells his shares. Sometimes, however, an investment company offers a no-load mutual fund, which doesn't carry any commission or sales charge. These funds are distributed directly by an investment company rather than through a secondary party. Some funds also charge fees and penalties for early withdrawals or selling the holding before a specific time has elapsed. Also, the rise of the ETFs, like we were talking about earlier, which so many people love now, have much lower fees thanks to their passive management structure. They have been given mutual funds considerable competition for investors' dollars, right? Like instead of going for mutual funds or index funds, like a lot of people are like, nah, I'm gonna go ETFs because there's no, like, the fees are usually pretty close to zero. There's articles from financial media outlets regarding how fund expense ratios and loads can eat into your rates of return. And it's a lot of people have got really upset about this, right? So I would say mutual funds and index funds are still really good, but having like an ETF, it's basically going to do the same thing without all the fees. Well, not all of them, but most of them, right? So let's talk about some advantages and disadvantages, right? So some advantages are going to be diversification, easy access, the economies of scale, professional management, the variety and freedom of choice, and transparency, right? So a lot of this means, like, again, you're not buying one specific company. Inside the fund, tens of companies, 50, hundreds of companies, there's no limit to how big it can be. So you're very diversified, right? Easy access, super easy to get into it, low cost management, transparency. You can go to that mutual fund and see every company in it, right? And there's so many different ones to choose from. There's no reason you can't find a mutual fund, just for you. So then what are some disadvantages of mutual funds? Well, the fluctuating returns, the cash drag, high costs, what's called it's dilution, but a lot of people call it diversification. Active fund management, that's those fees that eat away at your returns, right? The lack of liquidity, taxes, and evaluating funds, right? So you really got to pick and choose which one's better for you, and say, this is why a lot of people go to ETFs, right? I know I keep bringing that up, but this is a lot of people used to invest in, we're going to say 50 people who are 50 or older, most of them probably invested in mutual funds or index funds, stuff like that. But most people who are under the age of 50 probably started investing in ETFs, right? Especially people I know who are in their mid 20s, even into their 30s, late 30s. Most of them, they invest in the ETFs. So I want to talk about an example of a mutual fund, right? So one of the most famous mutual funds in the investment universe, right, is Fidelity Investments Magellan Fund, right? It was established in 1963. The fund had an investment objective of capital appreciation via investment in common stocks. The funds, I guess you'd call it their heyday, right, or their glory days, that were between 1977 and 1990, when Peter Lynch served as the portfolio manager, right? And under him, the assets under management increased from 18 million to 14 billion, right? So, and even after he left, the performance continued really good, right? And the assets under management grew to 110 billion by 2000, right? Making it the largest fund in the world. I think by 97, the fund had become so large that Fidelity closed it to new investors, and it didn't reopen until 2008. And I think as of last year in 2020, The Fidelity Magellan had over 20 billion in assets, and has been managed by his name is Sammy, and I don't know how to pronounce his last name. It's Simegar, right? And he's been managing it since 2019. So the fund's performance is pretty much tracked or slightly surpassed that of the S&P 500, but that's a lot of money. So, you can take all this information you need, try to figure out if this is something you want to invest in, or maybe you want to invest, in individual stocks yourself. I'm going to do a video on ETFs probably later down the line, and different, index funds and stuff like that. And hopefully, after you watch this, you can go watch those. But I really hope you guys like this video. Go ahead and give it a like, subscribe, and until I see y'all in the next video, y'all be safe.